All right, let's talk about the modern economic gauntlet. It really feels like the old rule book for building a secure future has just been shredded, right? And we're all left kind of trying to figure out the new game. So let's see if we can piece this puzzle together. So, why is building wealth so hard today? I mean, this is the question, right? You're probably working harder than ever, but those traditional milestones, buying a house, saving for retirement, they just feel like they're getting further and further away. We're going to break down exactly why that is. Okay, let's just start with a number that, honestly, it just stops you in your tracks. Negative 82%. According to Realtor.com, that's the collapse in the number of starter homes available in just one city, Memphis, Tennessee, over only 5 years. Think about that. This isn't just a statistic. For thousands of people, that's a door just slamming shut in their face. And that slam door, well, it brings us to our first big topic, the disappearing starter home. For generations, this was the first rung on the ladder of building wealth. But man, that rung is getting so much harder to grab onto. And look, this isn't just a Memphis problem. Not at all. This is a national thing. The total supply of those smaller entry-level homes, it's been slashed by more than half. And it's not just a shortage. You've got first-time buyers who are now in these crazy bidding wars with downsizing baby boomers, and get this, all cash investors who are just turning these places into rentals. The pool is smaller, and the competition is absolutely ferocious. And if you want to see the financial crunch in one picture, here it is. It's not just that there are fewer starter homes. The ones that are still out there have seen their prices skyrocket by 64% in just 5 years. Now look at the comparison. That's a way steeper climb than for bigger houses. So the most affordable rung on the property ladder is, ironically, becoming unaffordable the fastest. Wild, right? So let's just say you get lucky. You actually find one of those rare starter homes. Great! But now you're face to face with the first huge hurdle in actually buying it, a mountain of student debt. Yeah, before you can even dream about a down payment, you're starting your financial life deep in the red. And this isn't just a vague feeling of being behind. The data shows a really direct and powerful link between what you owe for school and your ability to ever own a home. And the numbers here, they really show how huge this one factor is. According to the Education Data Initiative, a full 51%, that's more than half of renters, point directly to student debt as the single biggest thing stopping them from buying a home. It's not just one reason on a long list. For most people, it's the reason. And you can actually see how this plays out mathematically. The data shows that for every extra $1,000 in student loan debt a recent college grad has, their chance of becoming a homeowner drops by 1.8%. It's like a direct, measurable weight, just pulling that dream of homeownership further and further down. So, with all that stacked against you, how do you even get ahead? Well, to try and overcome debt and start saving, millions of people are turning to the new frontier of work, the gig economy. It promises all this flexibility and opportunity, but as we're about to see, it comes with a serious trade-off. And by the way, the details we're about to get into are rock solid. They're not just pulled out of thin air. They come from a massive review that analyzed the findings of 92 different academic studies. So this isn't just a story. It's a clear, evidence-based picture of what's really happening. Okay, so here's that trade-off in black and white. The promise? Flexibility, low barrier to entry. This is the new side hustle, right? The new second job, born from an era where one income just doesn't cut it anymore. But the peril? It's a huge one if you're trying to build long-term wealth. Gig workers face insane income volatility. We're talking earnings swinging 30 to 50% from one month to the next. Then you add in zero health benefits, no employer-matched retirement plan, and big pay gaps, and what you have is a really, really shaky way to build a stable financial foundation. But let's say you do it. You navigate all of that, you clear your debt, you grind it out in the gig economy, and you actually manage to save some money. Okay, what's next? Well, the logical step is to invest it. And for decades, the safe bet, the no-brainer, was the classic 60-40 portfolio. But recently, that safety net just tore wide open. Negative 16.1%. Let that sink in. That was the return of the standard 60% stock, 40% bond portfolio back in 2022. And research from Marquette Associates confirms this was one of the worst years on record for what was supposed to be the most stable, most reliable investment strategy out there. Just gone.
Now, the crucial thing here is why it failed so badly. The whole idea behind the 60/40 is that when stocks fall, your bonds are supposed to rise and cushion the blow. But in 2022, we were facing historic inflation, and the Federal Reserve started hiking interest rates like crazy. Well, that hammered stocks because they hate higher borrowing costs, and it crushed existing bonds because their lower yields suddenly looked terrible. So they both tanked at the exact same time. The free lunch of diversification, it just wasn't on the menu that year.
But it's not all doom and gloom. The very same thing that caused the crash, those rising interest rates, actually has a silver lining. With rates so much higher now, bonds are actually expected to generate much better returns going forward. Marquette Associates even titled their report Back from the Dead, which tells you a lot. They're suggesting a potential rebirth for this old school strategy. Okay, so that crisis of faith in the old rules, it's fueled a really powerful cultural reaction. When the traditional path feels broken, people start looking for a new one. And that has led them straight to the wild frontier of online investment communities. This quote from a user on the Wall Street Bets subreddit, it just says it all. PE ratios are about as relevant as a telegraph operator's fingering speed. I mean, wow, it's a complete and total rejection of old school financial metrics. Forget balance sheets, forget fundamentals. This is all about narrative, momentum, and a collective belief that can, at least for a while, completely ignore reality. And it's so tempting to just dismiss all this as simple gambling, but I think it's deeper than that. This whole culture is a direct symptom of the economic gauntlet we've just been talking about. When starter homes are gone, when your debt is sky high, when your work is precarious, and even the safe investments blow up in your face, well, taking a high-risk shot on a meme stock can start to feel like the most rational choice you've got. So, after all that, where does this leave us? We've basically walked through a landscape where every single traditional step toward financial security has become more difficult, more precarious, or has just failed entirely. Let's just quickly run through that gauntlet one more time. Step 1, the goal, a vanishing supply of starter homes. Step 2, the hurdle, a mountain of student debt. Step 3, the grind, the total instability of the gig economy. And finally, step 4, the safety net, an investment playbook that just blew up. See, each step is a challenge on its own, but when you put them all together, they represent a fundamental, systemic shift in how things work. And that brings us to the final and most critical question. If the old map to financial security is torn, if it's tattered and useless, what will the new one even look like? For an entire generation, the challenge isn't just about following the path anymore. It's about drawing a whole new one from scratch. And what that map will look like? Well, that's the defining economic question of our time. Thanks for joining me to explore it.